Wilkins, qui est premier sous-gouverneur de la Banque du Canada. Monsieur Poloz va faire une déclaration, and after that, both of them will take your question.
Okay. Merci. Good morning. Bonjour tout le monde. Senior Deputy Governor Wilkins and I are happy to be here to answer your questions about today's interest rate announcement and our monetary policy report. But before taking your questions, let me briefly offer a few insights into Governing Council's deliberations. Inflation is on target, and the economy is operating close to potential. Now, that statement alone underscores the considerable progress that's been seen in the economy over the past 12 months. That said, interest rates remain very low relative to historical experience. And this is because the economy is not yet able to remain at full capacity on its own. Furthermore, the sustainability of this level of activity is not assured. Although we expect the economy to moderate in the second half of 2017, that moderation is extended into early 2018 and has been more pronounced than expected. Governing Council considered recent economic data very carefully and concluded that this softness early this year was due mainly to two temporary factors. The first relates to changes in mortgage rules that went into effect at the start of the year. This caused house sales to be pulled forward into the fourth quarter of 2017. Although we're still expecting the housing sector to moderate in 2018 compared with last year, we can expect a partial recovery of activity in the second quarter. Le deuxième facteur est la chute inattendue des exportations au premier trimestre. Cette chute était liée surtout à la congestion des infrastructures de transport. Cette évolution laisse entrevoir une reprise partielle au deuxième trimestre et plus tard dans l'année. Il convient de noter que nous prévoyons seulement un redressement partiel du niveau des exportations. Je vais revenir sur cette question dans quelques instants. Par conséquent, la croissance devrait rebondir fortement au deuxième trimestre après avoir manqué de vigueur au premier. Elle affichera ainsi un taux moyen d'environ 2% pour le premier semestre de l'année. Et elle retournera à un taux proche de celui de la production potentielle par la suite. Les mesures de relance budgétaire à l'échelon tant provincial que fédéral jouent un rôle dans cette prévision. Nous suivrons de très près les données du deuxième trimestre dans les prochaines semaines. Now, assuming our forecast remains on track, it's Governing Council's view that interest rates will need to move higher over time to keep inflation on target. We acknowledge that the forces weighing on the economy mean that monetary policy is likely to remain stimulative to some degree, even if it is less stimulative than today. By this we mean that interest rates may need to remain below the neutral range until various forces have dissipated. These would include, in particular, the uncertainty around trade conflicts and escalating geopolitical risks. We've reviewed our work on the neutral interest rate and concluded that it still lies somewhere in the range of 2.5% to 3.5%, given a 2% inflation rate. Now, another useful benchmark that entered our discussions was the real policy rate, which takes into account the rate of inflation on the policy rate. Today, this benchmark is at minus 0.75%. It's Governing Council's view that the need for a negative real policy rate continues to diminish steadily, albeit gradually. Most of our deliberations, therefore, concern the appropriate pace of interest rate increases. As we've said repeatedly in the past, this is an intensely data-dependent process of risk management. We continue to be faced with four key sources of uncertainty around the outlook for inflation. Each of these represents the potential for either upside or downside risk to the inflation outlook, and therefore needs to be assessed to ensure that our risks remain balanced around our 2% target. First of these is the issue of economic capacity. So we've done our extensive annual reassessment of economic potential and revised its profile higher, both in terms of its level and its growth rate. This means that we have a little more room for demand growth within our 2% inflation target than we believed before. Parallèlement, il devient de plus en plus évident que les défis du Canada en matière de compétitivité internationale nuisent à la tenue des exportations. Beaucoup d'entreprises fonctionnent à un niveau équivalent ou supérieur à leur capacité de production. Mais elles hésitent à investir dans de nouvelles capacités, étant donné notamment l'avenir incertain de l'ALENA, la congestion des infrastructures de transport et la pénurie de travailleurs qualifiés. Cette réticence à prendre de l'expansion contribue, pour sa part, à limiter la croissance de nos exportations. Il est possible que cette situation représente un changement structurel au sein de l'économie canadienne. La résolution de cet enjeu dépasserait la compétence de la politique monétaire. Pour la Banque centrale, l'effet net sur les perspectives de l'inflation lui servira de guide. La Banque poursuit ses travaux sur ces questions et présentera d'autres résultats au moment de la publication du RPM en juillet. The second issue is the dynamics of inflation itself. Recent data have been very reassuring. Indeed, the convergence of our three core measures, around 2%, as we forecast last year, has helped to buttress confidence in our inflation models. Our forecast now shows inflation rising modestly above 2%, due to temporary factors, and then easing back to about 2% during 2019. In this respect, it's worth underscoring that our target is a range of 1 to 3%, and that the average rate of inflation in the last few years has been below the midpoint of that range. The third issue is wage dynamics. Recent data have been encouraging. Our summary measures of various wage series, called Wage Common, shows that wage growth has picked up significantly in the last 18 months. And we've noted before that we would expect wages to be growing by around 3% in an economy operating close to capacity. We're approaching that zone now, although the latest figures have been boosted temporarily by minimum wage increases in some provinces. Furthermore, Governing Council acknowledged that these data can be difficult to interpret after a prolonged period of labor market slack. For example, wages tend not to decline during periods of high unemployment, as much as our models might predict. So when the economy recovers, there's a lag before average wages respond. All things considered, then, we continue to believe that there are elements of excess capacity in the labor market, as well as the possibility of productivity-enhancing labor market churn that will add to the economy's capacity. Fourth, Governing Council has been monitoring the data for evidence that the sensitivity of the economy to interest rates has risen along with household indebtedness. Now, this issue will take longer to assess, especially given that the housing market and mortgage lending have also been affected by the new mortgage guidelines. However, we did note that household credit growth has continued to moderate. This is an important signal that's consistent with the idea that households are beginning to adjust to higher interest rates and the new mortgage rules. Some progress has been made on the key issues being watched closely by Governing Council, particularly the dynamics of inflation and wage growth. This progress reinforces our view that higher interest rates will be warranted over time, although some degree of monetary policy accommodation likely will still be needed to keep inflation on target. The bank will also continue to monitor the economy's sensitivity to interest rate movements and the evolution of economic capacity. In this context, Governing Council will remain cautious with respect to future policy adjustments, guided by incoming data. And with that, Senior Deputy Governor Wilkins and I would be happy to answer your questions.
Andrew Hopkins, Reuters.
Thank you, Governor. Two of the four things that you were worried about are looking better. Does that give you more room to move sooner rather than later?
Well, we don't think of this as earning check marks or knocking issues off the table. It's more a question of, over time, the confidence that you have in the underlying framework, the narrative, and the models that support it. That confidence increases as the data, justify that confidence. So, and I mentioned that obviously the inflation data. If we go back to last summer, our three core measures were well below 2%. One of them was showing a sign of turning up. Our models suggested that we would be at 2% by now, and sure enough, that's what has happened. And so all that hard work of figuring out what's transitory and what's fundamental obviously paid off. The staff did a great job to sort those things out. So that gives us renewed confidence that we're on the right narrative, and so that one has, made us quite comfortable. Wages are, reassuring, as I said. They have picked up the pace since last summer, fall. But there are question marks around those data points, so it's not fully baked. So that's just two. And the other two, they're probably going to take a little longer. Capacity is a slow-moving process. But for sure, what's happened in the last 6 months is we see higher rates of investment overall. We got the revisions of the data from StatsCan that showed that investment was higher historically than they thought before. Therefore, the capital stock was bigger. So we have more potential, having revised our full framework. We do that in detail once a year. So we realize the economy has more capacity, and that one of our stories is that it will continue to build new capacity through this phase of the cycle. So it's encouraging, but it's I don't associate that progress, mechanically with any decision-making process. What we're looking for is a growing level of comfort with the narrative.
Compared to January, when we did a lot of talking about the North American Free Trade Agreement, there seems to be a sense that a favorable agreement is a little more possible. Businesses seem more confident, less scared that it's all going extremely badly. I'm wondering if there is a favorable resolution to NAFTA, does that give the bank a green light to go ahead on your tightening path?
No, as I said, the bank is decidedly data dependent. So the way the mechanism would work would be, of course, having the uncertainty around NAFTA resolved would be a positive, seen as a positive, but it would be a positive for businesses that make decisions. And then it would be those decisions that would then affect the economic data and give us increased confidence in the outlook. So there's a sort of an extra step in there, and it's still the data that would be most important to us. As I think we don't have hard data on how that uncertainty is affecting decision-making now. It's based on anecdotes, conversations, sentiment indicators, and therefore inserted as judgment into our forecast. So that judgment, of course, can be unwound through time if we have a resolution, but it's more, that would be in the outlook. You would still need the data to confirm that things had actually been made different by that.
Yaline Diaye, Market News International.
Thank you. I wanted to know if you, in your discussions this time around, you actually discussed a rate hike maybe earlier than before, because once in one of your statements you had said what you had discussed, and if this was on the table maybe earlier, did you do that this time? Did you discuss that?
Well, as we say in the statement, that Governing Council has agreed that over time the economy would appear to be warranting higher interest rates over time. Our uncertainty is about how much and at what pace, and the four areas of uncertainty that I highlighted basically distill all that uncertainty down to their implications for the inflation outlook. So inflation outlook is our guide. So if our inflation outlook is for 2%, given what we know, like as it is today, then we say, okay, so we're at about the right place. But if some of the issues that we're watching dissipate further, then the economy is strengthening more on its own, then it would be telling us that it needs less stimulus in order to maintain that level of activity. And so that's why it's so data dependent. And so for us, as I said, the case is clear. Interest rates are very low, considering that the economy is pretty well at capacity. Inflation's at 2%. So there is a sense that, almost by law of gravity, interest rates will move somewhat higher over time. But again, the pace is a significant question mark for us, given the data. So that's our answer. That's where we are.
So what is the most important element that would make you say that the economy can grow on its own?
Well, I would say at the heart of that is the investment export nexus. It's like they both are kind of joined together. So in fact, we have a lot of companies operating at full capacity and yet expressing a reluctance to expand capacity, to do the investment that would be needed to take on a higher export order. And so that reluctance to invest is related to things like the uncertainty around NAFTA, other competitiveness challenges that they face, whether they're transportation bottlenecks or, we mentioned others in the monetary policy report. So whatever those reasons, there's a variety of reasons that people mentioned during our BOSS discussions. They're hesitant to invest as much as they otherwise would. What that does is it prevents the economy from adding as much capacity as we would hope. It also prevents exports from growing as fast as we expected. And so those things kind of operate together. And so that signs in those two spaces that those constraints were either less active or people were just deciding, to just ignore them and carry on, and of which we do have evidence of, and the investment continues to grow. So the more that becomes widespread, then that would increase our confidence.
Greg Quinn, Bloomberg.
Good morning. Your statement does say that the higher rates will be warranted over time, and the debate was about the pace. Was there much discussion this time about moving rates now?
It's not about now or next time or some other time. It's about what is the underlying dynamics of the process that you've identified. And you have models which help give you kind of a benchmark, around that. And then you have the risks. And so you line up all the risks on the upside and the downside. And as I said, it's when it's that complex, balancing those risks around the 2% outlook is not an easy thing. So if it were mechanical, then it would be more of a, almost a mechanical question, yes or no. But it isn't like that. It's more about everybody getting a sense of what is the dynamic that they're sensing is appropriate, and what is the evidence they need to feel comfortable that that is right. So I'm not going to go into the nuts and bolts of what was out there.
Secondly, there have been assessments that Canada is losing, say, $15 billion a year from pipeline bottlenecks related to energy. Do you agree with that kind of assessment? And in the kind of world we're in, struggling to find sustainable growth, is it a significant opportunity to miss?
So I think that there's plenty of room for discussion around what the oil discount costs the economy. One company that has a fully integrated upstream, downstream business gets to internalize some of that. Other companies have their output already guaranteed a place on a pipeline, so they get WTI, not WCS. Transportation companies get some of the funds if they're moving the oil to a market. So all that makes it complicated, but also, not really the main issue for us. The main issue for us is that a relatively low price for Western Canada Select heavy oil means that that investment in future production capability in that space will be, discouraged. And that's exactly what we see in the data, that basically at these price levels, we're forecasting a flat performance in investment in that space. Because any new barrels that you bring to market from that space will be heavy and therefore will face the WCS price. And so that's how the mechanism works. So we believe we understand it, it's modeled properly, and so the model tells us this is what investment will be under these conditions. And if those conditions change, then of course the investment profile would change.
Kevin Carmichael, National Post.
Good morning. You mentioned in the statement that structural change might be affecting these capacity issues. Do either of you want to expand on what you're seeing there? What caused you to note that there could be some structural changes going on?
So, yeah. So what we're trying to say there is that we shouldn't think of an export shortfall relative to projection as purely a demand shortfall. That if it were, when we use the code word for economists, structural, that means that in the background there's something happening also on the supply side of the economy. So, we showed a chart in there, chart 18, I think it is, which shows how we've, mainly because of the growing share of China in global trade, you have this long-term decline in Canada's share of U.S. imports. So, of course, there are structural adjustments that happen, and those are not, it's not just a demand side thing, but a supply side. So to the extent that it's structural, then potential is changing at the same time, and so it's less of a monetary policy conundrum per se. It's got more deeper things in it that an interest rate change doesn't have any effect on. But if exports fell short for demand reasons, then that would be just like any other demand shock in the economy, and it's the province of interest rate policy. Would you like to add anything to that?
Just when you dig into exports and the different components of exports that are doing better than others, you can see that some of that decline you see in the chart of market share with the U.S. Really has a few industries that are contributing to that. Autos is obviously one of them, but there's also electronic equipment, foodstuffs. And if you combine that with another chart where we show where the capacity pressures are, you can see that those are the same industries that actually aren't experiencing capacity pressures. And so it looks like it's more of a structural decline than anything else. On the other end of the spectrum, for those exporters that are doing better, transportation, for example, some areas of services are doing very well indeed. It's really a question of, is it time now to invest to expand the capacity to meet the demand? And what we've decided in our baseline is that there will be some of that, but less than there would have been otherwise if there wasn't the NAFTA uncertainty and other things that are creating competitiveness issues, U.S. tax changes being one of them.
Yeah, I have a follow-up that's related to that. The NPR puts a fair amount of emphasis on, as you just did, Senior Deputy Governor Wilkins, on the strength in services, while, of course, noting the decline in shipments of manufactured goods. Forgive me if this question is too abstract, but is there a qualitative difference in an economy that's more driven by services exports versus exports of durable goods?
I would say no. The vast majority of our economy does consist of people working in the service sector. And in fact, even many people who work in the manufacturing sector are actually service workers. And so it's more convenient to think of fabrication as opposed to manufacturing, because manufacturing could be a complex supply chain where the fabrication gets done in lots of places, but there's not that many jobs involved. It's about the creation, the engineering, the marketing, the actual the stuff around the envelope. So, so those trends have been true for all time, like as productivity has risen in manufacturing, just as it happened before that in agriculture. employment continues to fall, and yet there's plenty more stuff for us to buy and use. And that the disproportionate growth happens in the service sector. So I think it does make the data more interesting. So, by the way, I think later this year, StatsCan will begin monthly as opposed to quarterly service export and service trade data, which will be a good enhancement, and it'll be a little more prominent in the month-to-month discussions of these data. And but also investment in the service sector looks different from what we're used to in the goods sector, where you got to have a factory and machinery to do things and so on. Whereas in services, it could be more abstract.
Software, for example.
Yeah, it could be software. It could be, in fact, just purchased on the cloud, so you don't actually buy anything. So the investment itself looks like it didn't happen, even though there's a payment every month for the underlying investment return. So that, in some ways, the economy is evolving in ways that will be a challenge for the data gatherers to stay up with, and so that's just another sort of bit of uncertainty that we'll need to inject into our thinking.
Kim Macro, Wall Street Journal.
Thank you.
Just a question about some of the housing comments in the monetary policy report. So I think there was a comment that some demand was pulled forward into the end of last year on housing because of the mortgage financing rules. You've said in the past that that housing markets in Vancouver and Toronto in particular were out of step with fundamentals. After you've seen some of the pullbacks, some of the slowdown, do you still see them as out of step with fundamentals, or has the slowdown taken care of that?
Certainly the supply and demand dynamics in the Toronto area and the Vancouver area have meant that the price increases there have been notable. And the changes to the mortgage underwriting rules, B20, have acted, and other changes in BC, for example, with respect to taxes, have restrained growth there. What we saw was a pull forward, as you would expect. People kind of rushed to get their house before the new rules came into effect on January the 1st, and that affected resales quite profoundly in Q1, particularly in Toronto. And what we expect, and we're seeing it already in the data, is that given that the fundamentals are still the same, especially with respect to supply, there's still a lot of demand as well, that there should be a rebound in the second quarter and some growth throughout the year, although less than before. Your question was really, are we back now to fundamentals? And it's a very difficult thing to call. I would say it's just too early to tell. The effects of B20, we've got subtracting about 0.2 off of GDP for the year, and so we expect the effects to continue throughout the year. I would say, though, that the most important thing to remember when it comes to these kinds of changes in macroprudential rules is that their effects tend to affect the level, and then on the growth rate, it just dissipates. And in fact, those are very important effects on the level. We talk as much about the use of these measures to improve the quality of debt as we do about what their effects are on the housing markets per se. And so we'll be watching very closely what that means for the distribution of household debt and distribution of households that are new borrowers who are highly indebted. We know from the last changes they made, it worked, and we'll be looking for the data this year to see what the effects of the new measures are.
Thanks. And you've said household credit has continued to moderate. Are there other factors that you look for in terms of the spread of household debt and how households are handling that debt?
We have data that it comes with a lag, but that can give us not only the aggregate debt to disposable income level for households, which everybody knows is quite high, around 170%. What's more important than that is really the distribution. And when we get those data, we can see how the distribution's changed. And just to give you an example, not this year, but last year, they made changes to the mortgage underwriting to have a stress test on insured mortgages. And what we saw there in the data when it came out was that the share of households that were highly indebted, so their loan to income was over 450%, fell from something in the high teens to around, well, below 10, so around 8, and it's probably fallen further. So we'll be looking for a similar kind of effect with the new measures, which are on uninsured mortgages.
Jonathan Wren? Yeah, Epoch Time.
Good morning. You seem to have a good handle on inflation with the models, and you mentioned at the start that it has reacted according to how your models had evaluated back last summer. Just, do you have any new understandings now on maybe why it's taken so long to get inflation back up to target, like all the measures, and given the amount of stimulus?
Sure. I think what we suspected all along was that we already had, to some degree, during that recovery phase, some of this capacity building that we've talked about, and that's kind of validated by the work we've done for this NPR, which moves up the level of potential output as well as the growth rate looking forward and backward. Okay, so it's some of that is literally due to the updated data that StatsCan delivers, which shows that the capital stock accumulated investment has been higher than previously believed in the database. And back in 2014 and 15 and 16, right? So not just a short time ago. So what that tells us is that back when we were, investigating why inflation wasn't moving up as much as our model suggested, the fact is the gap was bigger than we thought at the time. So that was always one of the things that we had in our minds, that that's possible, that could be the reason. If you just redefine potential output, that would explain most of the problems. And so I think, when we were sitting down last summer, I think we were getting more confident that we were heading towards a positive revision to potential output. And so that gave us the sense that, yeah, the model, if we were just to adjust it like this, it would give us the kind of inflation that we're expecting. And so it was an important call. I mean, this is, again, not a mechanical call, but a judgment call. And by the way, we've revised potential output for lots of places. Okay, so for many of the advanced economies in the same way. And so it's an important part of that global discussion about, how much is inflation less than expected. If you have the wrong or, too low of a potential output, then that will help you understand that. Okay, so do you want to add something about that?
Well, just a global, it's the same reason, especially for emerging economies. They have more capital stock. Interestingly, for the U.S. and for Europe, a little bit's more the reversal of the retreat from the labor market, so labor force participation's up, so trend labor's up. I would just say that as important as getting potential right, it's also making really good calls on what are the temporary factors affecting inflation. And last year, when it was lower, we knew we still had excess capacity. We thought maybe we had more than in our numbers, but we also knew that there were temporary effects coming from the energy rebates, from food, and other factors. And making those calls are really important because it means that you don't oversteer.
And just, I guess the other major economies or advanced economies have also seen this rise in inflation similar to Canada. I mean, is there some, I know in the NPR it specifically, there was a line saying that it's global factors are not as important or something like that with respect to the Canadian inflation, but you also have this thing happening coincidentally, so how much can you quantify that or add some color?
Well, so, if everybody's making progress in narrowing their output gaps, even if it turns out the gap was bigger a year ago or 2 years ago than you originally thought, it just helps you understand behavior then. But the fact that they've been closing steadily in many countries is reason enough that inflation should be coming up off that floor and heading towards something closer to the central bank's target. at different speeds in different places, of course. And as Carolyn says, sorting out the temporary from the fundamental is not an easy thing. And that was what our core measures were intended to do. That work kind of paid for itself over the past 12 months because as soon as we put them out, they fell. Made I know me nervous, like what's all that work, and now it's pointing the wrong way. But it was still now we realize it was the lagged effect of the widening of the output gap that happened in the wake of the oil price shock. Our output gap got quite a bit bigger during that period, and so there should be a fundamental easing in inflation. And then as that gap, that process of dynamics winds down, we return to growth, really rapid growth, as it turned out a year ago, was because the negatives became zero, or they just stopped falling. And so the positives became the dominant part in the data. And so that led to a pretty rapid closure, or narrowing at least, of that output gap, and inflation pretty smartly came up to its predicted level. But it's the temporary things are the things unwinding that are the most immediate things. The rest is kind of a much slower moving process and can be subject to lags.
Can I have a last name on my first round and then a name for a second round? So Andy Blatchford, CP.
Thanks for taking our questions. Today's NPR contains estimates on the negative GDP impacts related to investment and exports from uncertainties such as competitive challenges from the U.S. And I'm wondering, can you elaborate on how you came up with these estimates and how significant you think this will be for the economy as a whole?
Why don't you take that?
Well, on investment, the negative judgment comes from two sources. It comes from the tax changes in the U.S. as well as the uncertainty because of NAFTA, and it amounts on the level of investment to 3%, negative 3% by the end of 2020. So it's pretty significant. I think most of that, about 2/3 of that, is actually the NAFTA uncertainty. That's judgment. And what it's informed by is the information that we get from our Business Outlook survey. We spend a lot of time not only collecting regular data, which you've all seen, which show that investment appetite is actually quite positive, but it's less positive than it would be otherwise. And that's what we get from our conversations, not only from the Business Outlook survey, but from our other conversations we have with businesses across the country. And you can imagine why. I mean, some of these are really big investment decisions that they'd like to make, but their thinking is, yeah, I'm positive about that, but I'm just not sure that this is the right time given the uncertainty with respect to NAFTA. And then when it comes to taxes, they think, well, relatively speaking, if I've got a footprint in the U.S., it may be the right time to actually make use of that and expand there instead of in Canada. That's what we've used to inform our judgment. What's really important is what the governor has been saying quite a lot recently is you make those judgments to balance your forecast and then you watch the data very closely.
I also had a question on a slightly different topic. What's your assessment of the possible economic impacts of the developing pipeline dispute itself in Alberta and BC, and how beneficial do you think this pipeline could be for the Canadian economy?
Well, a tough question, and it's obviously a very fraught situation. But so it's not our job to comment on that per se, Andy. We've incorporated, as Carolyn just outlined, negative effects on investment, which are related to uncertainty. In the oil patch, as I mentioned before, investment is lower than it would be if we didn't have transportation bottlenecks, because WCS would be a higher number. Those are modeled and they're there, and if that situation changes, then we would go through and change our assumptions in the model and figure out what it meant. I don't have anything for you that's concrete about how it's affecting the outlook today per se.
Governor, we were talking before you came in the room about...
Oh, wait a minute. That's not allowed?
A disconnect. Well, see, but I'm going to tell you what we're saying.
Oh, okay.
About a disconnect of what we thought you said and what the market reaction was. And now as these analyst notes come in, there's, some third perspectives. And content aside, there's a lot of content in the NPR that's valuable, but the message is not clear. I'm confused by what you're trying to say about the future of monetary policy, and I'm wondering if you could sum up what your message is.
Okay, well, I'm not pleased to discover that you're confused, so let me try. So the economy is in a good place. It has reached almost, we think, or very close to its potential capacity output. Inflation is at 2%. That's a good starting point since that's the destination. However, all is not quite normal. Interest rates are still very low, and it's obvious that interest rates are playing an important role in getting us to that place. So behind that is an analysis that says, you know, without low interest rates, somehow the economy would not be where it is today. That means that there are things in the background, forces acting. Sometimes we call them headwinds. There are things acting in the economy, some of which are legacy of the financial crisis, the accumulation of debt, the uncertainty around NAFTA, the competitiveness challenges. It's a long list of things that are in the background that would be preventing the economy from getting all the way where it is today all by itself. So policy is playing a role, and not just monetary, but fiscal, in getting us there. And so the question for us then is how does the process work from here? How do those things unwind in the background, making it less necessary over time for policy to be there to keep the economy where it is today? And so that's why we're analyzing those four issues in particular, but you know, there's lots of questions buried within that. So as we go forward, that's what we do, and we say, well, given where the economy is, then it's very likely that the economy that higher interest rates will be warranted over time. But we can't be definitive about when or at what pace, because those underlying issues are all evolving differently, and they're not that observable. We need to watch how the data are performing, and do our job of balancing those risks from decision to decision. And so in the statement, it says clearly that the Governing Council believes that interest rates will move higher over time, and that some of the things that we're monitoring are likely to be there for some time. Therefore, that it is very likely that we will still need some stimulus, albeit perhaps less than today, you know, sometime in the future, in order to maintain our inflation target. So in other words, some of the forces that are acting are very long-term forces. And going back to Kevin's question, at some point, maybe a force becomes structural, in which case it's no longer a cyclical or demand phenomenon. And that's the sort of assessment which is harder to make, but of course that's the kind of work we'll be doing between now and the next NPR around this, you know, renewed export question that we're wrestling with. So does that help you?
Yes, it does. Can I ask about that? One of those four things, the sensitivity to interest rate hikes.
Yeah.
What makes you as optimistic as you are about housing, that this, you know, the resales will pick up in Q2 or whatever the phrasing was, given that one of your previous reports talked about how half of mortgages are renewing this year? It's a sort of disproportionate renewal rate, and the B20 means they're not going to qualify at the rate that they used to qualify. So this is going to play out all year long. Why are you as confident as you are about households and their gigantic debt?
Well, I'll just offer my broad take on that, and then I'll let Carolyn go into a couple of details. But you know, we obviously have a situation here where it's hard to read the data because we have a big fluctuation there. We put in these new rules, and all things equal, we would have expected some reaction to the rules. But what happened instead was people pulled their house purchase into Q4, and therefore they're no longer going to buy a house in the first quarter, plus the people that have decided they are putting off their decision or what have you. There's many ways to adjust to new rules, such as buying a smaller home or whatever, so people have to have time to adjust. But that flip has been exaggerated, right, by the pull forward effect. And it makes it hard for us to read, you know, how much is the true reaction to the new rules and how much is just timing. So that's going to take a little bit more time for us to sort out. And in the background, of course, interest rates are a little higher, as you say. So, by the way, nearly half of this business, nearly half households renewing. No, about a quarter or close to 25 to 30% of households renew their mortgage in a year. And that's because on average people take like 3, 4, like on average it's, you know, lots of 5-year mortgages in the mix. But about a quarter of people have a floating rate mortgage. And so that's how you get up to 40-something% because they chose floating, so it floats. So it's not a renewal. So it's an interest rate risk as opposed to renewal risk, if you like to make that distinction. Okay? And there now I've set the table for you to fill in all my blanks.
Yeah, so not everybody. I think that was the factual thing. It's 25% renewals, and the rest are just variable rates that are affected by the interest rates. You know, when you think about the fixed versus not fixed and who will meet and who won't, you've got to remember that those who have a fixed rate that's less than 2 years, of which there are quite a few, actually already had to qualify at the 5-year rate, and so you know, the number of borrowers may not seem as high from that number as it would seem. I think the other thing that's really important is just looking at how did people respond to the previous B20 change. And you did slow down. It was temporary because it was an adjustment to a new level, and then the growth rate picked up again. Fundamentals were the same. But part of it is because we could tell through some of the data that about half of the people that were affected actually just adjusted by waiting a bit longer or by buying a smaller house. So it's not a buy or don't buy example. And then for those that renew, that have a 5-year, that had a 5-year fixed and they just happen to be coming up, well, they've had 5 years to hopefully pay down their principal, of which many do. And so they're renewing with a different set of parameters. And if they wanted to, they could extend their amortization. And so again, there are different ways to adjust. That being said, we do expect B20 to have a dampening effect on housing throughout the year, but not to see the continued decline like we saw in Q1. We expect it to bounce back. And just a final thing, you have to remember that with an economy that's growing the way it is, employment growth and income growth in Toronto and in BC and Ontario, as well as throughout the country, is really, from a demand point of view, supporting the household sector.
Yeah, I mean, housing starts have remained very strong.
Yeah.
And they don't build a house until it's sold, or a condo development would be, say, 70% sold before it would be built. And so that suggests that the underlying fundamentals of demand remain very solid, which is consistent with the rest of our narrative.
Merci beaucoup. Thank you very much.
Thanks, everybody.